Bonjour tout le monde, welcome to another episode of the Point of No Return podcast, the show where we go behind the scenes to understand the secrets and strategies of the most interesting Canadian technology companies. On this week's show, I had the pleasure of speaking with a good friend, Isaac Souweine, partner at Pender Ventures. I'm really happy Isaac took the time to talk about his move to Pender Ventures, where he just joined as a partner, and to talk about their $100 million fund focused on early stage, I want to say Series A companies with vertical specifically. It's a really interesting conversation. Isaac, I had him on 5 years ago, so it's been a while, and it was a good excuse to catch up. Isaac is really one of the smartest software investors I know, and you'll really see from this episode, just given his breadth of knowledge on the history of the Canadian technology landscape and really his active role in helping shape it. So we spoke a lot about, obviously, Pender Ventures and Pender within the broader Pender Fund, which is out of Vancouver. Really fascinating company and entity, which Isaac will explain. We talked about their investment thesis and focusing on profitable growth and really being, I want to say, a little bit more incisive in terms of how they invest and having really this focused thesis. We spoke about resiliency, right? Particularly in this time, the difficult market conditions for a startup. And then, of course, we spoke about generative AI and Isaac's thoughts on it. He pretends to not know about software, but he actually has some very interesting thoughts on the whole space. I really think you'll enjoy today's episode. Isaac, real pleasure to have you on again, man. It's been, we were talking about it before, it's been 5 years since you had the podcast. Obviously, I've seen you recently, but 5 years since we did it. You're at Real at that time. I guess first question is a general one is, you recently joined Pender. Just walk us through that move. Why did you join?
Sure, absolutely. And first of all, what a pleasure to be back. It's amazing how 5 years can fly by. A lot has happened. And in the meantime, you've been doing amazing work connecting with people in the ecosystem and keeping this podcast going. It's just what a pleasure to be back and get a chance to chat with you. To backtrack a little bit more, I started my career in product management and had an awesome run doing that in the US and Singapore, moved to Montreal, kept doing it. And then Real Ventures gave me this incredible opportunity to try out something totally new in my career, related to what I'd been doing in the past, but to try out early stage investing. And what an incredible opportunity. It is such a fun job. It is so gratifying to be able to work with companies in that way, to be able to provide them capital, support, to do ecosystem building and community building as really part of your job. And so it wasn't a dream that I had, but nevertheless, it was a dream come true to be able to do that work. And Real Ventures is just an incredible firm. The way they work, the individual people, the mindset, the impact that the firm has had on the community. So just a fabulous place for me. And I just have nothing but positive memories and positive things to say about that. Nothing lasts forever. And for me personally, as I looked at my career and what I wanted to accomplish and what environment would put me in the best place to accomplish that, it became clear to me I needed to go do something else. And part of that was about what was happening at Real Ventures. Part of that was just where I was at in my career. And so it was just time for a change. And when you go around and look for something like that, it's actually not that easy in a way. Not that I've been so successful, but at least had enough success to become a partner at a firm and establish a track record. And so then it's, can I really find something that actually fits me and where I would have a home and an opportunity to express myself and where I could be working with people that I respected, where I could keep learning, where I could maybe try something out new. So it was not easy to find a setup like that. And so I was very excited and grateful to find the team at Pender Ventures, which frankly, because it's such a Vancouver focused organization, or has been, I didn't really know Maria and I didn't know Dave, who's the CEO, and I didn't have a lot of exposure to what the firm was doing. So it was a revelation to learn about the Pender strategy, which I think we'll talk about it, and the history of the firm and the way they work. But after I got a chance to meet all of these people and interact with them, it became clear, this is my next act. This is a place where I can thrive and where I can learn. And so I think we'll get into it more, but that was it. It was about finding my next act, and just super happy to have landed with this group.
Yeah. And it feels like a natural evolution for you as well, right? You were such a important part of the Montreal ecosystem, broadening up, going a little bit later stage, pan-Canadian seems to make sense, right? Maybe you spoke about the history of Pender, like for people that are less familiar. I wasn't familiar, obviously, when you joined. So maybe just give us a little bit of the run through.
Absolutely. So Pender Ventures is quite excellent story and inspiring, shows you what good people can do if they put their mind to it. So it started about 20 years ago in Vancouver. And the very initial germ of it, Dave Barr and a couple of other people did want to do venture capital and what we do today, but ended up finding more of a home for various reasons doing public market investing and specifically small cap technology stocks, small cap Canadian technology stocks. And they were good at it. And it's a very value focused, think of it as a real alpha shop, meaning trying to understand the unique asset. What is this business? Who's running it? Why do they have an advantage? And finding the gems and making money doing that. And from that seed of doing small cap investing, added corporate debt, which has been very successful. And over these 20 years went from zero under management to about $2.5 billion under management. And just to clarify how the firm works, so we're like a mutual fund company, and we have these products that are sold through the retail channel, so through wealth managers across Canada. And we're really, Pender Fund is investing kind of the retirement funds of average everyday Canadians in these value-focused strategies. And so that has been very successful. A firm like that, and specifically Pender, is always looking to launch new strategies. And so over the course of that 20 years, not just the corporate debt, but other public market strategies, part of that evolution around 2017, 2018 was say, hey, maybe we can go back to our original roots and reestablish a private company investment strategy, really a venture capital or private equity strategy. And that is the start of the Pender Ventures story within the larger Pender Fund organization. Maria Pacello, who's the managing partner of Pender Ventures and also the founding partner, had known Dave for a long time. She had done a ton of investing in the Vancouver ecosystem and had gone through the whole life cycle of funds and raising funds, managing them, and exiting companies. So a really experienced, established, and well-respected investor in that community. So she came on, and together and with some other folks at the firm, especially Kendall, who's the principal and was a part of the Fund One team, they raised $25 million and really started investing. And just to clarify, even though we're part of this larger asset manager, the structure of Pender Ventures in particular is the structure of any kind of venture capital firm that you would see in Canada. 10-year investment period, 2-year extension. We charge some fees. We have carried interest. And our LPs are the kind of similar sorts of LPs, institutions, high net worths, and the same types of folks that would invest in other Canadian VC funds. We have maybe a unique access to certain types of LPs, especially in the wealth management world, because we're working with wealth managers so much on the public side. But overall, Pender Ventures is a kind of standard venture capital firm inside of this bigger family of investment strategies. The support of Pender Fund gives us a bunch of extra legs up. Obviously, they're backing us with capital. So as we build the firm, we have their financial support. We're part of the larger Pender Fund investment team. So once a week, we meet with the people who are doing the bond strategies and the small cap strategies and the other stuff. We exchange information. We learn from them, do a couple of offsites over the years. And so we have some extra edge that comes from that, but ultimately we're doing our own thing. And so that 2018 fund, Pender Ventures' first fund, has been successful, made 10 investments, a couple of excellent companies in the portfolio. The most notable is Jane App, which is a clinic management software for physiotherapists, chiropractors, and other allied health practitioners. We entered on our own, actually, via a secondary where we bought out some of the old founders. I'll talk a little bit more about how we invest, but we are open to creative types of structures. We invested when the company was doing about $5 million in revenue and profitable. I can share these numbers because they are public. They're now doing $60 million in recurring revenue. They're still profitable. They've taken on a couple of other financing partners. So really just a dream come true type of investment. And there's other great companies in the portfolio as well. So the numbers are good. The strategy has shown to be very promising. what do you do then? You go and try and get more capital to deploy against the strategy. We're investing at the Series A stage. A $25 million fund is subscale to do that. So the vision for Fund 2 is the same strategy, which I'll talk a little bit more about, but bigger, $100 million fund, pan-Canadian, so to have investment people across the country to be sourcing deals, also sourcing capital. So bigger fund, meaning bigger checks and bigger ability to influence the companies and support them, more coverage across the country. And that's where I entered the story. As Maria and Kendall and Dave and the team were thinking about how to expand, it was natural to look somewhere in the East so that we could cover all of Canada. And this was at the same time, going back to what we started with, where I was looking for my next move. And so we connected and it came together. We're lucky to have another colleague that we found at about the same time in Montreal, whose name is Miriam Lakmami, who was previously at BDC Women in Tech. And so now the team is 4 investment professionals, 2 in Vancouver, 2 in Montreal, going after this vision for Fund 2. And happily, we've actually closed $50 million. So we're actively now in market and investing. 2023 is about raising the other $50 million and probably making 1 or 2 more investments. We've actually made 3 investments out of the fund already. So we're really up and going. And just to frame the strategy a little bit and pause, and we'll see where it goes from there. We are Series A stage, roughly. We're very proof-focused investors. So we're looking for at least a couple $1 million in ARR. The range is usually about 2 to 4. We want companies that have demonstrated pretty clear signs of product market fit. They have an established go-to-market. They know how to sell the product. They don't just have 1 or 2 companies. They have 1 or 2 customers. They have a variety of customers. And so they've gotten past that early product and go-to-market risk. We are investing in scaling risk. Can they take it from 2 to 5 or from 4 to 8 to 12 to 15? And that's our entry point. In terms of what technologies, we're definitely software investors. The particular areas that we focus on, number 1 is health tech, sometimes called health IT. So basically software for the healthcare industry, could be software for pharmaceutical workflows, could be, as with Jane, clinic management, EMR or other kind of systems of record, decision support where you have software that helps doctors or clinicians make decisions. So there's a whole kind of gamut of software solutions that are in there as part of the workflow of a hospital or a clinic. So that's our first area, health IT. And then the rest of it is all B2B software and for the most part, vertical SaaS. So software built for a particular industry. And the reason we like vertical SaaS, a couple of things. One, in vertical SaaS, if you're building software for the real estate industry or the travel industry or the legal industry, the customer is usually very well defined. That means it's easier to figure out what they need. It's easier relatively. I'm not saying it's easy, but it's relatively easier to build a product that satisfies those needs. The go-to-market is more straightforward because you're going after these customers that go to this trade show or buy products in this way. And they're often less competitive markets. Often in these vertical software markets, you have a couple of established legacy players whose software is aging out and cash cow type of software. And so these newer companies can come in and they're not fighting against 20 or 30 other players, but there's maybe just a couple of competitors. So all of those characteristics we like. The other thing we like, you can see from the picture that I just painted, it is easier to run those businesses in a capital efficient way. You need less capital to grow the business, to do go-to-market, to do product development. Everything is a little bit simpler. And we have a preference for capital efficient growth. We will back companies that are burning capital and losing money. But if they are, we want to know that they're doing so in a disciplined, structured way. We want them to have a fairly clear path to profitability, not some 7 to 8 years out, but a couple of years out. And we also do a lot of companies that are already profitable or cash flow break even. We fund a lot of bootstrapped companies that were their first injection of capital. And so that's our flavor, health tech, SaaS, and a sort of the more disciplined side of the early stage venture capital ecosystem.
Yeah, very cool, Isaac. Very cool, man. There's a lot to unpack, and I find there's a lot of interesting areas. I'll maybe take, because you spoke a lot about the what you invest in and then in the where. I want to take a step back and just one question on the history. Oh yeah, and also one small point. You introduced me to Miriam, your team member, like super smart, right? So I find you guys have a really solid team. You spoke about Pender Fund. Just how big is the fund itself? AUM?
The parent company is 2.5 billion under management.
Okay. Yeah. So I was going to say, it's interesting as why they would also be an LP in the venture fund. So I find it's an interesting strategic move to do, right? To be able to feed the innovation economy for the next companies that will go public. So like from a strategic sense, also just a pure return sense. Did you have any other color there as to the overall approach as to why Pender Fund would back Pender Ventures?
Sure. That's a great question. And just to clarify the structure, in fact, Pender Fund does control some assets that allow it to be not Pender Fund exactly, but some of the funds it manages to be an LP. So we are our own LP and we have a way of investing in the fund. But the primary relationship between Pender Fund and Pender Ventures is you can think of them as owning the management company. These venture capital firms have there's a GP, a general partner, and behind that, there's a management company that runs the various funds. In our case, the management company is Pender Fund. So Pender Fund owns the management company. And so to rephrase your question, why would Pender Fund want to own a venture capital management company or become a venture capital management company? I would say there's a couple reasons. One, there's just, and this I know from talking to Dave and others, there's just a true love and appreciation for what happens in the early stage innovation ecosystem. Investing in the public markets, you can have a big influence on the company. You can get some information about what's going on, but that's nothing like what you can get when you dig deep with a private company. And the impact you can have as an investor is much bigger if you come in earlier. So I think part of it is just a love for what happens at these very early stages. If you're passionate about investing with an alpha mindset, it's almost like you have to be drawn to venture capital because it's the purest sort of alpha style investing. You're picking, especially if you do it like us, very concentrated portfolios, you're picking very specific assets, and then you are really putting your shoulder into that company, sitting on the board and having a big influence. So part of it is just that passion for investing, but also the structure of venture capital firms and the way they make money is different. And fundamentally, VC, and this is different from most of the other strategies, shares in the profits. There's carried interest. Carried interest is just profit sharing. And because it's such a difficult investing, and probably there's other historical reasons that I don't even know, the share is pretty significant. There's a 20% profit share on most of these venture capital funds. That means Pender Fund and all of us who are involved, we can make money from the fees, but we can actually make quite a significant amount of money if the fund is successful. So that sharing in the upside, there's some real financial motivation on the behalf of Pender Fund and everyone involved to say, hey, imagine if you got 500 million or more under management, even at 100 million or 150, which is where we're headed, if you return a 3x fund, you can do the math. Like that's some real value, and some of the carried interest goes back to Pender Fund. So there's definitely a financial motivation. The third thing that I would add is not only do we make money in a slightly different way, we source capital from a different group of people. So Pender Fund, the parent company, is sourcing capital in a very particular way through these retail channels, through wealth managers, and sourcing, let's say, little chunks of capital at a time. Every wealth manager is making a decision to buy a bit more of this mutual fund or this corporate bond fund. Venture capital firms and private equity source most of their capital from institutions in much bigger chunks. And there's a natural fit there because the institutions are comfortable with one of the facets of venture capital that would really push individuals away, which is the lockup period. It's a 10-year plus 2-year lockup period. For your retirement account, you might not want that long of a lockup. If you're a pension fund or a bank, that's fine. You're going to be around for hopefully hundreds of years. And if you have a venture capital strategy or a private strategy, you now have something to go sell to these institutions. It's not the only thing that we would offer them, and we can do institutional sales for some of our other products, but it gives us a real entry point into institutional sales, which is something that Pender Fund wants to do anyway. So those are a few of the motivations. And I would say, I would also add fourth one, which is more contingent but important. If you're run, what I've seen in the way that Pender Fund is run, and I think this is probably typical of most investment firms, certainly in venture capital, but across the board, you got to find great people. And if you got great people, you want to run with those people. And then you find more great people and you want to help them grow and have their own fund, everything. Dave, knowing Maria for a long time, Maria's a great person. Like, she's a talent. Like, she's a respected, accomplished person. So if he and the firm has a chance to work with her, great. What does she know how to do? She knows how to do venture capital. So I think part of it is just about, hey, this person is available. How can we get a chance to work with her? So I think that's a bunch of different factors that drove it.
Great story, man. Fascinating to unpack. And the strategy makes so much sense. Maybe let's unpack the strategy side, right? So you mentioned how it's similar to how other VC firms are set up, but we were talking about a little bit before how it's different, right? So the concentrated aspect and also the types of companies you go after. So maybe talk about a little bit what differentiates your strategy.
Sure. I think concentration versus breadth is a sort of vector that you can divide a lot of different firms on, right? Like, some firms are, and very simply, the more diversified you are, the more positions you take, the better chance you have of delivering some kind of returns, right? Because you're de-risking the portfolio, but you're decreasing the potential for a really big outcome. And the more concentrated you are, you're saying, I have more confidence in the positions I'm taking. I've dug deep and I really understand this move. And so I think you can find any sort of, if you take a slice of venture capital firms from seed, Series A, Series B, you're going to find some who go more for diversification and try to build bigger portfolios. And then you have some that look for more concentration. So we're in that concentration family, but there are many people in that group, I would say. The more distinct part, if you look at this world of B2B software investing, now, things are changing. We've just come out of a boom time, but boom or bust, up market or not, there's a large part of the venture capital ecosystem, and I think this will stay true, that really focuses on the size of the market, the ability or demonstrated ability or possibility of growing very fast. And that's the formula. And then if you put all the deals in the spreadsheet, you're going like, all right, I want to swing for a home run every time. I want to go for a very large market every time. I want a company that can grow very fast every single time. And I want the case that every one of these could be the 2x fund maker. I'm just going to be unicorn hunting always. I'm going to be swinging for a home run every time. And if you watch baseball, I know it's not the perfect sports analogy in Canada, but if you watch baseball and you look at people who are swinging for a home run every time, what happens? They strike out a lot. It's high risk, high reward. And there's a comfort level, like, you can make money that way. There's a science to that kind of VC. Swing for a home run every time. You're going to miss a lot, but a few of them will make your fund 2 or 3 times over. That is not what we do. It's not that we don't want to hit a home run, and we can hit home runs with our strategy. Jane is a perfect example, like absolute home run investment. But we look at things a little bit differently. We say, first of all, if it's a massive market that's totally horizontal in nature, so it's like some sort of cloud software that anybody can use, and there's tons and tons of competitors, it's going to probably require tons and tons of capital to fund the company over many rounds. That's just not our kind of business. It's not that you can't make a killing doing that. So we stay out of high burning businesses. We stay out of super competitive markets where there's lots and lots of people in them. We don't like companies that need tons and tons of capital to grow. We're on the totally other side of the spectrum. We're looking for companies that can grow in a very efficient way. We're looking for companies that ideally have already demonstrated the ability. So we're conservative in that nature. We don't want you to come in and say, we think it's going to be great. We're like, hey, show us the revenue, show us the customer base. And so everything about what we're doing is a little bit more disciplined, sober and focused. And then you have to say, where can I find? So that's great. Who doesn't want a profitable software company that's growing well? So where are you going to find those opportunities? And what do you have to give up to find those opportunities? So one way you can find those opportunities is you find companies that just never really raised capital. Either they were just awesomely kick-ass profitable from day one, or they had to grind it out over many years. But one way or another, they got there on their own. Maybe there was some love money, maybe there was some BDC debt, but they never really entered into the sort of venture capital treadmill or whatever you call it. As a result, they're often A, very off the map. Nobody really knows about them. B, not necessarily really seeking out capital. They're not out there at pitch competitions or sending people their decks. They may not really need the capital. And by need, a lot of the companies that I described in this sort of go big or go home, they have to raise money. They're running at a major loss. They don't raise capital, they go bankrupt. So you find these other companies, and this is category one for us, where they're off the map. Nobody really knows about them. They don't need the capital because they're profitable or effectively profitable. But often, once they get to a certain $3-4 million, they look ahead of themselves. They go, oh, wow, this is actually a big market opportunity. And we got here the hard way. But now we see that if we're going to get the next 5 million in ARR or 10 million ARR, it might be hard to do this on our own. And also, if we hit the capital markets now, we can probably do so on our own terms. We can pick the partner that we want. We don't have to get forced into it. And so even though these companies got from 0 to 1 on their own, they might want to do 1 to 2 with a partner. Those are great opportunities because often you're not heavily competing for them. And because we specialize a bit in them, we can come in and say, hey, we understand this kind of business. And we know how to work with a company like this. For the record, we want you to grow faster. We want to go big and all of this stuff. We're a venture capital firm, but we're one that's a bit customized for your situation. So strategy one is to find companies that kind of got there on their own and were bootstrapped. The other strategy is stay within the lane of VC-backed, seed, angel, whatever it is, but find the companies that A, were a little bit more disciplined in the way they got funded and the way they grew. So instead of taking a $5 million seed round, they took a $1 million seed round, you know what I mean? That sort of thing. And then 2, often those companies are going after markets that are perceived as being a little bit subscale for that traditional VC model that I just described. If you want to take a massive big swing at a market with huge TAM and huge growth potential, you want huge TAM. You want to be able to see that it's a $100 billion market. And so if there's this software company and you ask them how big is their TAM and they don't tell you it's 10 or $15 billion, a lot of the VCs will just walk away. Hey, that's not a big enough opportunity. Whereas we look at it and go, the TAM might be smaller, but it's also therefore much less competitive. It's much easier to go to market, all the things I was talking about before. And some of these market opportunities are a lot bigger than you thought they were, especially as you move from one related vertical to the next. And if you think about the way Jane is thinking about the world today, okay, so they're the market leader in chiropractor and they're the market leader in physiotherapist. What other allied health professions are there out there that could use the software? And I won't go into the details, but there are other ones. So we think the TAM on some of these opportunities is misconstrued, it's underestimated. And so those are the kind of 2 sourcing strategies. Either look for these off-the-map bootstrap companies or look for these companies in markets that are a little bit underappreciated by the traditional VC style. And I will say, we were talking before we started, it's taken me a little bit of time to get my head around the strategy and then adjust my approach to sourcing to produce these opportunities. But in fact, and of course, it shouldn't even come as a surprise, but there's tons of them out there. And once you tell people, because the sourcing still works in a similar way, you go have coffee with that person, play tennis with that person, some connected person in the industry. And then they say, what are you guys up to? And you explain the strategy and they go, oh, I got a company for you. And it's not necessarily the one they would have sent you if you're running a different strategy. So it turns out there's tons of companies that fit this model. And then when you meet them and you explain that your strategy is built for them, there's some natural opportunity for potential collaboration.
I love the strategy, obviously. And I also love the fact that it's so well articulated. Like you guys are able to explain it, define it, and then say, these are the companies we're going after versus, like you said, the go big or go home kind of equation, which ends up being vanilla for a lot of firms. And then maybe one other piece on this is the notion of TAM, right? You mentioned the TAM is too small, but software is very malleable, right? So it can expand, and it's also, I guess you can ask ChatGPTs like how big the TAM is, but these things are very, very conceptual, right? They can grow to a large extent. So even like you said, sometimes we discover small markets can actually be really big ones too.
Yeah, and there's just I was on the phone with a company today that's selling software in a vertical, really doing excellent within Canada, looking to expand to the US. And clearly that's a growth pattern for many companies. But I asked them a little bit about how you're going to grow. And this, I'm being vague, so I don't want to talk too much about a private company. And they were able to explain that there's like a set of workflows and services that are adjacent to what their software does in their market that are like high margin, large opportunity, that their software gives them the kind of entry point to offer a whole set of other services. And so it's often that case. If you have, and mind you, you need must-have ROI generating system of record software, like software that is not nice to have, but actually is crucial to the way some kind of company runs its business. If you have that kind of software and you're in there creating value for that company and it's super sticky and it's recurring revenue, it just opens all kinds of doors for what else you would do, whether it's adding features in your software, whether it's moving to some adjacent set of use cases and flows or services within their industry, or of course, moving into verticals. Success breeds success with these kind of things. And the way you phrased it is exactly right. Software is very malleable. So the speed at which a successful software company can establish a whole new line of business, it's like breathtaking, right? It can happen very quickly. And so this is all how we see the world. And we just find there's, and I just want to say, none of this is to disparage other VC firms and how they work, nor to paint them with some kind of broad brush. We're actively co-investing with lots of great firms in Canada and in the US. Who doesn't appreciate a well-run company? And if it's not burning a lot of capital, it's not like other investors are like, oh, I wish you were burning millions. So there's many firms that we can collaborate with on this kind of strategy. And the other thing, I think this was Pender Ventures' strategy from day one. Even in the boom market, Pender Ventures was started in 2018 during just the absolute crazy run up. And it was a good strategy even then. It is an extremely well-placed strategy for these kind of more compressed market times, because the go big or go home strategy and burning lots of capital, it pretty much assumes very fluid capital markets all the way. Even to like being able to list a company that's still losing a lot of money. When capital becomes much more constrained, you no longer have the promise that there's going to be some Series B and Series C as long as you're just showing the growth. So then looking for companies that have very controlled burn rates that can flip to profitability when they need it. So we find there's it's uncovering more deal opportunities because these are the companies that sort of thrive in this environment. And from our own investors' point of view and raising money from limited partners, it's certainly, story is resounding in a way that it might not have a couple of years ago, because they themselves are aware of some of the challenges of the last sort of few years in the boom times.
Yeah, it makes me think of something I read on your website, right? You invest based on 5 pillars: validated, scalable, impactful, diverse, and then resilient, right? The first 4, I could think very easy to explain. The last one I'd like to unpack just a bit, right? Because I think you mentioned it, right? Like resilient startups, but I like your perspective on it.
Yeah, resilience and capital efficiency and the ability to flip to profitability are so interlinked. If you are really in the hands of your investors and future investors to keep funding your losses forever, you are inherently not that resilient. If, on the other hand, you're profitable or quasi-profitable, or you can show a near path to profitability, your ability to survive in difficult times is just increased massively. And resilience is the ability to adjust to the times and see your way through. So I think part of it is about the way a company manages cash and spends money. But another major source of resilience, to bring it back to something I talked about a moment ago, if you build must-have software that is absolutely crucial to the functioning of the company you sell it to, it's not nice to have. It means even when they're cutting their software spend, they're not going to cut yours. Like they're going to stick with you. Very customer-focused companies that really, for however they were financed and however much capital they burn, focused on creating a solution that was absolutely essential to the customers they sell it to. That's going to create a lot of resilience as well. So those are a couple of things that we look for. And for the record, resilience is also driven by things that are, I think, common to everyone's thesis, like a team and culture that is behind a company is a massive source of resilience. If you have a strong company culture, well-articulated values, strong leadership, great way of moving people through and promoting them, these are things that create resilience. If you don't, and people are just there because the thing was growing really fast and it was sexy, well, they're also going to leave as soon as things start to look a little bit off. And we see this in our companies: excellent employee retention, excellent employee satisfaction. So there's a lot of ways to become resilient. And I think it's impossible to, I shouldn't say impossible, it's difficult to identify resilience in a boom market. Everything's just being floated by cheap money. Now there's going to be a few years of pain. We're not nearly through it. And the pain comes because you're saying, oh, that company in the end wasn't that resilient because of its business model and its capital structure and all of that. Not that it wasn't a good company or didn't have good people or wasn't doing something cool, but resilience is about being able to survive and thrive in any market condition.
Yeah, like the old Buffett analogy that's overused, right? The people swimming naked when the tide goes out.
There you go. So that's it. And it's not because, again, they were doing something wrong or whatever, but it's just like, some approaches are different than others. And when you get money was chasing more and more fringe opportunities by the end of it, because that's what happens. Like all the good ones were already gone.
Yeah. Congrats on the first close, man. It's so exciting to see you guys go. I would be remiss to not ask you about generative AI. You wrote a very insightful post on it, and which I'll link to obviously in the show notes. But I want to unpack a little bit your thoughts. You're a seasoned software investor, right? What are your thoughts? What the F is going on lately? And even since you wrote that post, so much has happened. I'd just like you to pick your thoughts on the generative AI space. Obviously, you're following it closely. And then again, that article is really well written. I'd just like to pick your brain on it.
Sure. Wow. What a fast moving technology space. And it's funny because when I joined Real, like that was, let's call that was like AI hype 1.0, and it was when Element was financed, and there was like some massive excitement about machine learning and whatever AI was in 2015, 2016, which for the record was a lot about structured data sets that had been tagged for some reason. And that actually produced a ton of value, even if not every company was successful. That the ability of, if you actively train an AI system and say, this is what this data point and this is what this is over and over again, if you tell it a million times that this is a dog and this is a cat, it's going to be able to identify the difference between a dog and a cat. And so AI 1.0 has produced a ton of value across the enterprise software world because the capabilities were really powerful. And even some of the stuff that we use in day-to-day voice recognition and translation, some of this stuff was just driven by these, like going in and tagging massive data sets. The generative AI revolution, and I'll be careful about, take everything with a grain of salt because I'm certainly not on the software side of it, but my understanding of the revolution is, oh, now there's a way for the AI to train itself in an unsupervised way. You can just feed it not a little bit of information, like you can feed it like the entire internet, basically.
The corpus of human knowledge.
The corpus of written down human knowledge, or the corpus of visual knowledge. And because of these new architectures and transformers and adversarial networks, the AI can consume everything and then practice on itself and learn to make like accurate predictions without anybody having told it whether it was right or wrong. So it's comparing to the data sets that it already had. That capability, and then people going, oh, let's see what happens when you put more data in it and more data and more data. And you can see the charts of how big these models are. They just got really big, really fast. It just unlocked this capability set that didn't exist with the previous set of AI technologies. And it's staggering. And I don't need to tell you, you just go to ChatGPT or go to Stable Diffusion or whatever, and you're like, oh my gosh, I can't believe this is possible. So that is a major technological revolution that happened very quickly. And for the record, still some of the leading figures, it's less Canada-centric than AI1 was, but there's still some of the leading companies are in Canada. So we still can lay claim to some of that. So that's the technological revolution. It's easy to see how many different applications there are for search or effectively search-like things, for content generation, for coding, and basically having an assistant that can help code for you. So there's like all of these ways that the technology is literally coming to market today in products, whether it's a brand new product or it's like being embedded into all sorts of products, whether that be like embedded into Bing or embedded into Adobe or Notion or Canva or whatever. That's the lay of the land today. It's moving staggeringly fast. We are not horizontal software investors. We're not going to invest in like a copywriting tool that's for anybody or a graphic design tool that's for anybody. We are really more vertically focused software investors. So that after I roughly wrap my head a little bit around the technology, the question that I ask myself and that we ask ourselves as a team is, okay, for the areas that we play in, how is this technology going to have an impact? And so that's what I was writing about. And the points, I guess the crucial point that the article made is to be successful in a vertical use case, a very specific use case, let's say creating architectural plans or construction plans or legal documents or some very narrow field, the bar is going to be one level higher than it is. Not that the bar is not high today for what the large language models do, but the bar is going to be one level higher because the use cases are very specific. The accuracy level that's needed, let's take healthcare, for example. Think about how you can't just be right usually. You got to like always be right. So the accuracy level has to be very high and the use cases are very specific. And LLMs and all of these large models today, they weren't even built to do that. They're built to generically do stuff. And so to get into the vertical world, there will have to be another wave where you have another data set that sort of sits on top of or underneath, however you want to visualize it, which is that vertically specific data set. And you'll need this combo of the big large language model or the large something model combined with data that's specific to that industry. And then you'll need users, because I skipped over one thing that was really cool about generative AI and why did ChatGPT work so well. You had this model that had roughly trained itself, but then you build a system for users to further train it, right? So they use the model and they go, no, that answer did not make sense. And then it feeds back in. And so there is a training component to generative AI. So to get vertically focused generative AI, you need to have users in that space train it. So that's what I was talking about. And the prediction is simply, yes, it's definitely going to happen. It will take time. There will be, in my view, generative AI first vertical software companies. In the meantime, the other big question, which is a little bit of a trickier and multifaceted one, is what about all the vertical software companies that are already in market doing 5 million in ARR, 10 million, 50 million in ARR? They weren't built as AI companies. how do they use this technology? Should they use it, and in what ways? And there's no simple answer, but certainly they need to think about it, because what is generative AI? It's effectively now another piece of the software development stack. It is an API that you can ping and get a result back. How are you going to build that in? And so in the article, I talked about, first of all, finding ways to integrate this technology into your company outside of your core product. How do you integrate it into your go-to-market? Because it's great for content marketing. How do you integrate it into your internal ops? So a company is not just its product, it has its own operations. And so how can the software get baked in? Then how can you think about baking it into your core product while you're doing all the other stuff? Not an easy thing. And actually the next step for me in my learning journey is to spend more time with our portfolio and with other companies that are in the space and live and say, so how are you using this tech, if at all? And how do you view it going forward? So anyway, that's a few thoughts on the topic.
Yeah, it's a fascinating topic, right? And I think it shows that it feels not even the iPhone moment. It feels like the biggest thing to happen to the industry. So I can't think of a better place than to be a partner at a fund investing in Series A companies, verticalized, like talk about right timing. It feels like probably the best time to invest now moving forward since 2005 kind of thing, right? Like in the sense of we're just coming, the valuations have crashed. There's this brand new technology that's changing the world. It feels like a lot of generational type companies are going to be formed right now.
I think it's going to be a good time for the reasons that you just described. I would say two things. One, optimistic, and one, what's hard. The optimistic thing is, what is the real secular shift? Software is the real secular shift, and it's not even close to over. So the digitization and then automation, which is maybe a word for AI, but the digitization of work and the moving processes so that they're on a computer or on a phone or on a device, the data is structured, it's accurate or whatever. That's not over. It's a lot has happened. So if you look around in many workplaces, where it's there, but it hasn't been completed at any level, number one. Two, software ages out. So there's software from the last generation of digitization that needs to be replaced by like totally new software built on a new stack with a new design. And so all of that is to say, it's always a good time to invest in software, because it's A, there's many more things to digitize, and B, there's like versions of software that need to be replaced. On the AI side, especially exciting to have the software stack or the capabilities of software continuing to evolve. To have an edge in a market like that is very difficult. In the same way that, what was it, a couple of years ago, I think the technology was less significant in a way. When crypto was all the rage, it's like, to have an edge investing in crypto, like you better know it really well, because otherwise for everyone who's winning on a trade, there's going to be someone else losing. So similarly with generative AI, super exciting time. If you want to win making investments in like that, you do have to put in the work and come to deeply understand it. And the reason we do write articles and stuff like that, partially is to express ourselves and expand the brand and get people to know about it. A lot is just to advance our own learning, so we can at least have a chance of knowing what's going on, so we can be up on it. So when we see an opportunity, we feel qualified to do it. But when technology moves that quickly, it is not easy to be ahead of the game. And so it's an exciting time, but it's a challenging time to stay abreast of everything.
Yeah, the sands feel like they're definitely shifting. And Isaac, thank you so much for your time. It's been a fascinating conversation. I won't take up more of it. I guess my final classic closing question is, people want to reach out, connect, learn more about Pender Ventures. What's the best way?
Sure. We're online, of course. We have a website, and we do respond to all the inquiries off of there. We're on LinkedIn, and myself, I try to interact a lot on LinkedIn. So you can just find me, Isaac Souweine, on Twitter as well, where it's a little bit more fun and funky interaction. So that's Son of Sarah on Twitter. And out in the Montreal and Toronto and all the ecosystem, I'm also involved in a couple of other kind of community projects, especially Front Row Ventures, where I'm a board member. This is a student-focused VC, and APM Montreal, which is a training program for up-and-coming product managers, as well as APM Canada, which is the organization trying to push those out. So if you're interested in student VC or product management and building community in the product management world, that's another way that we could potentially interface. And love meeting new people, new companies, and people in the ecosystem. I would love to hear from you.
Isaac, thank you so much, man. As always, thanks for listening, and don't forget to subscribe. If you want to learn more, check out thepnr.com.